Today, the Lok Sabha has passed the Finance Bill 2023. 64 official amendments have been made, and they've been including the withdrawal of those long-term capital gains tax, the LTCG benefits on certain categories of debt mutual funds. And these will also be set up as far as the GST Appelate Tribunal is concerned. They are also going to be able to do that now with the amendment that has been made. The Finance Bill that gives effect to tax proposals has been passed without discussion. The question now is, how is it going to impact mutual fund schemes? We're going to discuss that with our guest tonight. But first, let's bring in my colleague Sharad. He's here to give us an overview of what the Finance Bill had, the amendment over there, and how the LTCG benefit is going to go away from certain debt schemes. Sharad.
Well, yes, to simplify it, the long-term indexation which benefits was there earlier for the debt fund schemes and also for gold-related schemes and international fund of funds has actually come out of it. And now the normal slab rate would be implied, and this is of course coming in to actually remove the tax loopholes. And of course the asset management industry has turned very cautious. Now let's look at the impact analysis. We have just created an impact analysis. Like if you have been investing via the old method, which is currently existing right now, at least till 31st March, over there itself you would see strong kind of gains coming in. But as we compare it with other schemes, like once you are in the tax slab rate, then your profit on investment, be it in your investment slab rate between 9 to 12 lakh where it's a 15% tax rate, or maybe something like above 15 lakh where most of the HNI deposits come in, so your tax component will actually go up and your returns will be less. Now of course after that the question remains is, where will this money go? That is what we have been talking with experts, and they have stated that money will flow into equity savings, fixed deposits, corporate FD bonds, which generally give a yield of almost 8 to 11%. And do remember, these are the hybrid instruments in the equity schemes. And of course more physical buying of gold could be there apart from the sovereign gold bonds. Now the entire debt mutual fund industry, what's at stake? And if you talk about it, the debt funds are almost 13 lakh crore. Now that is a big amount coming in, and this also includes the liquid portion, but on the illiquid portion, that's roughly 20% of the total AUM size. Apart from this, the impact is something which we'll be talking about, and of course a negative impact coming in for the asset management companies. However, a slight positive impact coming for the banks as well. But as you rightly pointed out, NBFCs also seeing a second order pain coming in because of the rise in the cost of fundings. Now we try to decode what's the investor profile looking like, especially for the debt oriented funds, and this is coming only for the long term funds. And as per the Amphi data, corporates are having 55 exposure to it, while the HNIs are having 39%. But for the retail, it's at a negligible 4%.
All right, but let's break this down. How this is going to change the nature of the business of the mutual fund industry, especially the debt side. And of course, as far as investors are concerned, do they need to really change their strategy now that LTCG benefits are going away from certain debt schemes? To discuss this, the director of Canara Bank, B P Sharma, is joining us, along with financial planner Amit Kukreja. He's the founder of AmitKukreja.com. And Sandeep Bagla is with us as well, the CEO of Trust Mutual Fund. Great to have you with us, gentlemen, to be able to break down this for our viewers. But coming to you first, Sandeep Bagla. At this time, we are charged a flat 20% long-term capital gains tax on our debt mutual fund units if they are sold after 3 years from the date of investments. What role has this long-term capital gains benefit played in really developing India's debt market in your understanding, and how much of a hit do you see to investors from that benefit now getting withdrawn?
So just to put things in perspective, the Indian debt market is quite large, and there are many more significant players of much stronger balance sheets and larger corpuses who are operating in the debt market. So while definitely the tax benefits have been a strong part of the user experience, and given all things are equal, investors tend to invest in debt funds because of the tax benefits to a certain extent. But I think, as your colleague Sharad said, that there are 13 or 14 lakh crores worth of mutual fund debt schemes right now, out of which, let's say 5 lakhs are in liquid fund. There are further 3-4 lakh crores in shorter end maturities. So only 2 2 to 3 lakh crores worth of securities or schemes are going to get actually impacted. So last 2 years, because of the interest rate cycle has been moving upwards, there has been net outflows from debt mutual funds.
Right.
The only schemes that have seen inflows are the target maturity funds, which basically take a particular date and invest in securities in and around that date, mostly government securities. And the investor is able to lock into a particular yield. And since interest rates have been rising, these funds have become quite popular as the post-tax yields have been quite reasonably high. However, this is like absolutely passive fund management where the fund manager has to really do not much but to manage the flows, and all the inflows and outflows are only in that maturity bucket. Now, this corpus actually grew to about 1.5 lakh crores or 2 lakh crores, which was quite substantial. Now, the investors who have invested in this are unlikely to withdraw right now because they will wait for the 3 years to get completed and to avail the tax benefit. However, incremental flows might not come into these funds. What could be on the brighter side, the monies have not been coming into actively managed funds, and actively managed funds have given very good returns in times when interest rates are coming down. So there could be movement into actively managed funds going forward. So this is where we are. We don't see much of an
Yes,
impact.
Sandeep Bagla, but this is about the picture that you're painting for us is about the here and now of our investments right now. You're talking about an interest rate cycle that we're in where we're moving up, and perhaps soon we are going to see a pause as well. So in terms of what the future, even the distant future looks like for the debt market right now, that's also something one should consider because the benefit is getting pulled out and we don't know whether it's going to come in or not, but on the face of it, it seems like it won't. Mr. Sharma, do you believe that in a sense this would classify all debt funds under the short-term capital gains category and as an extension also become highly beneficial to bank deposits because now debt funds will be at par with fixed deposits, won't they, at least on the taxation front?
First of all, it was a loophole in the law which now stands rectified. The benefit to banks, I'll not see that way, as you have rightly told. All the investors in the debt instrument in mutual fund will wait for a period of 3 years before they withdraw it because they are protected for this tax benefit under long-term capital gain for investment made up to 31st March. But eventually, the growth of AUM by mutual funds under this fixed return group will take a hit. Absolutely no doubt about that. Mutual funds have now to compete with banks, both in terms of risk management and return.
There's no taking away from that. Amit Kukreja, do come in. Do you also see a lot of investors now switching from debt to equity as well because of this finance bill amendment that has been made, or perhaps opting for instruments that are not as popular today, like the equity savings funds that hold 35% in debt with the rest in arbitrage and equities, or perhaps even insurance savings products? Will those benefit, do you think?
So I see two levels of changes happening, Vikram. One, people who were new to the mutual fund investments will take a step back because the debt fund investment was a very good stepping stone to understand how this whole mutual fund space works with respect to diversification of underlying assets and tax efficiency. So suddenly, any new investor who wanted to get a feel of how this mutual fund works will take a step back because he's not going to witness the tax efficiency aspect. However, we shouldn't forget debt funds are still advantageous because they give us the advantage of partial redemption. They still give us the advantage of power of compounding with respect to fixed deposits. There is no TDS in debt funds, and there is also a strong ability to set off your losses if you incur losses, right? So these are still strong favoring aspects of mutual fund investments through debt funds. So investor who is still an aware investor, he will not make a knee-jerk reaction of exiting or will not make a knee-jerk reaction of not investing any further. But as you said, there's going to be a completely change of flavor, change of inclination for investing in another set of mutual funds, which could be heavily equity mutual funds, or it could be equity savings funds, or hybrid category funds, which are not impacted, anything which has an equity percentage of 35 to 65% or more than 65% equity allocation. So the whole awareness is going to change, and investor inclination to accordingly pick and choose the schemes which is serving the purpose of reaching the financial goal faster will also evolve. As I see, as the economies grow, as the interest rates rationalize, these things will keep on happening, and investor will accordingly fine-tune their inclination for the products which will serve their purpose. So I see a good transformation happening. And of course, there is, as I said, two phases. One, the fresh investor will become even more cautious, and the seasoned investor will show its flexibility to choose the right set of schemes, which will help him achieve his or her financial goals faster.
Right, and you bring up an important point, Amit Kukreja, because as far as investments go, I don't know, there is always a priority list, but where tax benefits are concerned, where it falls in that priority list, I'm not quite certain, because it is about goals that much more. It's about what you want to achieve in how much time. Sandeep Bagla, do come in. What about HNIs? They have traditionally stronger holdings in fixed income financial products. Now, with the indexation advantage that is going away, will they be less motivated to park money in debt, in gold, in international funds as well?
See, I wouldn't really know about gold and international funds.
Okay.
See, eventually people do invest for returns. And if the underlying scheme is not performing, then people will stay away from the scheme, from the particular asset category. So you will see that while equities have gained in the last 7 years, and that's why the fund flow into equities has been very strong and resilient. Similarly, fixed income schemes yields have been going up, so there's not much money coming to fixed income schemes. So I think the primary objective should be, other than tax benefits, it should be the returns, your asset goals, and one thing Mr. Kukreja did not mention as benefits of the debt funds, open-ended debt funds, is their ability to generate capital gains when interest rates are coming down. So if interest rates are coming down by, let's say, 100 basis points from 8% to 7%, the return to the investor will be 15% in a year. Now, that is something which typically people don't talk about because it's difficult to predict. The last 10 years, I have seen a CRISIL bond fund index has given a return of about 8.75%. The only problem is that sometimes the returns are 4%, sometimes the returns are 13%. So FDs do score over other investment opportunities like open-ended debt funds, that they have a coupon, but at the same time, they are passive and there is no upside to it. In mutual funds, in debt mutual funds, besides the passive funds, in actively managed equity funds, there is a potential upside if interest rates come down. That is an aspect which has unfortunately been highlighted less in the last few years, and the passive schemes have taken over. And now we are looking at a time when the passive schemes can take a backseat, and possibly the incremental flow will come not only based on the portfolio yield, but also a look at the overall interest rate environment.
Well, what you're saying, Sandeep Bagla, should be music to Mr. Sharma's ears if there are more deposits coming the way of banks. Mr. Sharma, do you think this is going to shrink our debt capital market in India? And if so, how do you think that's going to impact corporate debt, the money that companies need for their capex cycles? The onus is now going to fall that much more on banks. So how equipped is our banking system to take this on?
Well, I'll explain it a bit lighter mode. See, there is a saying, कि दोनों हाथ में लड्डू. But mutual fund, it was दो हाथ में लड्डू, मुंह में लड्डू. Whatever they are investing, they are getting tax benefit under Section 80C. The market risk was minimized by diverting a huge portfolio to debt instrument. Am I audible?
Please go ahead. We like the concept of dono haath mein laddu, which is something that I...
तीसरा लड्डू में आ रहा हूँ.
Okay.
तीसरा लड्डू यही था कि whatever they gain,
yes,
once the period it's monetized, it was subject to long-term capital gain tax, which literally works out to nil tax. तो मुंह वाला लड्डू तो निकल गया. So mutual fund will have problem in mobilizing AUM. That is for sure. But what he has told, active management of mutual funds, here comes the real test. The return and the risk management of the mutual funds will determine who will survive and who will not survive.
No, fair
Banks
point.
definitely in short term, some deposit may come. Today, because the interest rate is very high, but tomorrow the interest rate goes down.
Yes.
The situation may not be that rosier.
Exactly.
But all said and done,
Yes.
a investor who has a risk appetite will only go to mutual fund
Yes.
henceforth.
Yes.
Others will stay put in fixed debt instrument. I'll give you another example. We're discussing so much on this.
Yes.
Let us talk of an instrument which for the purpose of investment is equity, even inferior to equity.
Yes.
So far return is concerned, it is a debt instrument. This is known as 81 bonds.
Correct.
Okay.
Yes.
Now there, whatever coupon rate he is getting, he is paying tax, normal tax, that is as per the slabs applicable to the recipient.
Correct.
And I need not tell the name of the bank.
Yes.
The bank has the option to write down this investment
Yes.
without any compensation.
Correct.
Now on that also they are paying tax. How come the fixed income group in mutual fund will be given a different treatment?
Correct.
So the third laddu is out of the mouth.
Yes.
From
That point is well taken. That point is well taken. But for the moment, what are investors likely to do? Amit Kukreja, before 31st of March, by the end of the month, do you see a lot of money come into debt schemes? Because clearly, once you put money into debt funds before the 31st of March, you can hold it as long as you want and claim indexation as long as you want to. So do you see a big rush in debt schemes between now and the month end? What are you advising?
So again, phases of reaction. The first reaction is going to be, oh my God, what's going to happen to my portfolio now? So an immediate assessment of the portfolio with the financial advisor or just by himself or herself. Second, let's just put in the money in debt funds because this is going to be more tax efficient, and let's just make sure that the NAV is allotted to us before 31st of March. So I see that wave also coming. I see a major purchase of debt funds happening because people in the end of the day in this country are very hungry for tax efficiencies. So people who have understood mutual funds and they see that their financial goals are within the 3 to 4 year horizon, they will jump on this opportunity for last few days in this financial year to buy the debt funds. Number three, people will try to revisit their financial goals, and all sensible investors will not have a knee-jerk reaction to this. They will see what are the possible opportunities for us even now. Let's look at the holistic situation of financial goals and the plan, and then accordingly change the investment schemes or the holdings that we have over the course of time. So 3 phases of reaction: denial, shock, and an immediate adoption, buying as much as possible because the goal is within the 3 to 4 year horizon. And third is, let's just take it with a pinch of salt. Let's just go ahead and see what the impact is, and then holistically evaluate and take the call based on what and when my financial goals are required to be funded.
Succinctly said, Amit Kukreja, that's from the investor side. Now, if you look at it from the mutual fund industry side, Sandeep Bagla, do tell us, how much of a hit do you see in the business of asset management? Today, we saw some of those asset management stocks really bleed in trade, but that's a knee-jerk reaction. But going ahead, in terms of the strategy of the mutual fund business, how radically do you see it changing?
See, that's what I was trying to say, that, today I don't see much change, but as you were right, that in the future, yes, people would take more factors into account while allocating money to debt funds, other than just the tax part. So I think in terms of business, I would say maybe it would be 5-7% of the business in debt schemes would be impacted. In terms of earnings, it would be fairly minuscule. So I don't think that in terms of the future of the AMC business, this will make a very, very big change. Yes, it is not a positive sign. It's a a mildly negative sign. But if mutual funds can pivot and come out with schemes which offer other benefits as compared to just the tax benefits, I think it will not make a meaningful difference to the bottom lines of the AMCs.
Government's rationale is going to be different on this. Obviously, they're trying to bring some of these debt instruments at par. Mr. Sharma, are you convinced about the government's rationale to tax debt fund holdings on the basis of the income tax slab that an investor falls under? What do you think the rationale is, and is it going to be served?
No, that's a very right step, and it was overdue.
Is it? It was overdue, Mr. Sharma believes. Amit Kukreja, what do you think? Do you think there could be any kind of review as far as the proposed change in the finance bill is concerned? Because a lot of people within the industry, a lot of investors would want a rethink on this.
I absolutely believe it's time the rethinking is due, because we still have capital assets which have different ways of assessing the long-term capital gains and thus the long-term capital gains taxes. Real estate has a different LTCG definition, short-term debt fund and long-term debt, the debt funds have a different LTCG definition now. Then there is this hybrid fund which has a different LTCG definition. Then there is equity which has a different LTCG definition. Where do we get the advantage of indexation? Where do we don't get the advantage of indexation? The international funds, the gold, etc. I think from an investor's perspective, investor is looking for consistency and clarity. He wants to make a good long-term decision with respect to choosing the investments which is going to help him or her serve his financial goals, the ultimate purpose of reaching the goals in a much faster manner with capital protection, tax efficiency, and the alpha that he gets. So the rethinking is still due. I think somebody needs to take a stock of this overall situation with respect to investments from an investor's perspective and eliminate these anomalies that we have with respect to different asset classes. So I think we still have a way to go, and I hope that sanity, that consistency, that rationalization across the asset classes happens sooner, so that investor can just relax and focus on long-term wealth creation and his financial goals fulfillment.
Win-win-win kind of scenario where the government wins, the investor wins, and the mutual fund industry wins. That's the ideal kind of scenario. How far we are away from that, that remains to be seen. But this is a move. It is for real, and it's something that is out there. Now, how investors are going to react to the LTCG benefit being taken away from certain debt instruments remains to be seen. We continue to track that universe. But for the moment, Mr. Sharma, Amit Kukreja, Sandeep Bagla, many thanks for joining us with your perspective and your insight on this discussion on India Tonight.